Welcome, everyone, and thank you for joining. Looks like we still have a few more coming in, but we're going to go ahead and get started. My name is Austin Rutherford. I'm the Vice President of Data Analytics at eCapital Advisors, an IBM Premier Business Partner. Over the past several months, I've had the pleasure of working with several community and regional banks and have seen and heard some very common themes that we built this webinar around. It was our goal in putting together this webinar that we'd focus on business challenges and really not make it a product pitch webinar. After the event, we'd love to get your feedback to see if we've hit this mark or how we can make the next one better. We'd like to make this one of several series of financial services webinars to help present to our community. Until the last few years, it was really only palatable for large banks with deep pockets and large teams to be able to implement analytical solutions. We believe that limitation has changed, and all sizes of banks, whether you're a $40 billion bank in assets or $1 billion in assets, there's no barrier anymore for entry points to this. We have a really packed agenda. We're going to be putting in a lot of information over the next hour. For a quick recap of the agenda, we're going to cover some intros. We're going to spend very little time, but just want to introduce the team that's going to be presenting. We'll go through some key topics and challenges, and then Chuck and Mike are going to divide and conquer on a couple key areas around customer insights, profitability analytics, regulatory compliance, and risk data aggregation. We'll have a live Q&A where we'll open up the mics at the end, but we encourage throughout the entire webinar to use the chat window. And you can use the chat window to all participants or just send it to the panelists, whatever you feel comfortable with. We'll be monitoring that chat window. As we can, we'll try to respond real time or include as a part of the webinar presentation. All right, so intros. So I've already kind of introduced myself with eCapital Advisors. I have one slide that'll cover a little bit of background on that. We have Chuck Swiger from IBM and Mike Weigel, and we're very privileged to have them on the phone today. These gentlemen have, I think it's over 20 years each, significant amounts of financial services expertise in a variety of different areas. These are really some of the go-to people within the industry that our key accounts reach out to help solve some pretty complex problems. So very appreciate their time and joining and putting some of this content together. Also on the phone, we have Nicole Mancini. She's a financial services account executive. We've also included the contact information, so you're welcome to reach out to any of these after the webinar as well. So next slide. So eCapital, high level, I'm not going to give a long background. We're based out of Minneapolis, Minnesota. We're a premier IBM business partner. We're one of the top resellers of business analytics software in the Americas. We're really focused on selling business analytics and information management, both software and solutions. So we have a consulting team both in the business analytics and information management to help make customers successful. All right, so without further ado, I'm going to hand things over to Chuck to help get things started.
Thanks, Austin. Everybody, we appreciate the opportunity to go through this with you. As Austin said, please enter any questions in the chat room. We'll make sure we get to them before we all leave the phone today. So we've got a fairly packed agenda as far as topics are concerned, and so we want to get right to it. We're going to talk about customer relationships and how critical that is to the banking industry. And I know that there's some credit unions on the call as well, and not maybe all of this will apply to credit unions, but much of it will, so I apologize for all of it that doesn't. We're going to talk about profitability analytics and just extending the analytics that you have and that you're doing that now beyond your traditional core banking capabilities and how profitability analytics can help you do that. We're going to have a discussion around regulatory requirements because it's such an important and changing area of what financial institutions are facing and how fast it's moving and what it means to your risk and how you do your business. We're going to talk a bit about risk as fuel for growth, and I know that that's a topic that's been in the financial services industry now for a while, and Mike's going to cover quite a bit on that. And then we're going to kind of make sure we talk about the data and the timely, reliable use of it and reporting, because in the end, without that, none of this can happen. So let's get right to it. So we've listed some top challenges here that community banks are facing, and I know Austin mentioned it at the beginning that big banks have been doing a lot of analytics for a long time, and have spent a lot of money doing it. And at times, community banks felt that it was just too expensive or too hard to do, and weren't necessarily taking the advantage of what technology and some of the new solutions can do, and how that's changing now. That's why I've got that word. That's why we've got the word historically there in front of that second bullet. But you know, in the past and even today, lots of Excel sheets are used. You know, we kind of call it Excel hell, but it's necessary, and it's a tool that's used to do a lot of analytics within not just community banks but large banks as well. And with the introduction of new products that banks are trying to introduce to their customers, integrating those new products into reporting is oftentimes difficult. The whole data governance issue, especially since many community banks have small information technology teams, is difficult, and the integrity of that data and the security of that data is so important. We're going to focus a lot on the customer and how the challenges that community banks and smaller financial institutions have in improving their deep relationship with their customers, and what does that mean, and how can new solutions help improve your relationship with your customers. We'll talk about the 360-degree view, the customer churn, all those issues, and then of course preparing for and managing increasing the regulations, which there's a lot of new solutions out now in the marketplace that can help you do that. We realize these aren't all the challenges that community banks face, but we, based on our experience and our work with financial institutions, especially in the small to mid-size, we see these as very critical, and we're happy to talk about any others beyond this. So I'm going to start out with just a high-level overview about the business requirements, not technology requirements, but business requirements for success in today's world. And my belief, and in IBM's belief, the two at the bottom are critical there. Integrating risk management and focusing on the customer, and all of these are tied together because it's really about a new business model for banks. And the pressure for banks to increase revenue, to make money, to keep their customers, to interact with their customers is growing every day. And so we feel these three areas are absolutely critical for success in the environment. So I'm going to start talking about customer insight, because our belief is that it all starts with the customer and it ends with the customer. And I really want to talk about some of the areas that are new in the market as far as being able to improve your customer relationship. Today's customers, as you guys know more than anyone, they want a personalized experience. Actually, we want a personalized experience in everything we do with organizations, whether it's a retail organization or a bank or anybody else. We all want that. We all have mobile phones. We all use social media. It is the way of the world, and customers want you to, know them better. They want you to protect them, especially as far as security is concerned. They want you to anticipate their needs. I still get incredible, I know everybody does, amount of mail that comes that's totally unrelated to my life, where I am in my life. My kids are older now, so I don't need stuff that, relates to having new children. Making it convenient to interact with them so that it's easy. I trying to remember the last time I actually walked into a teller, walked into a bank. I use social media a lot. I think we all do. And to remember everything I do with them. I mean, all customers want to remember your interactions. So that's really about that seamless, personalized experience. And right now, there's an opportunity on how banks can generate these insights and engage. And I want to talk a bit about the four that I've listed here. Because today, right now, all organizations, I know your organization, segments your customers. You target offers based on some high-level segmentation, whether it's demographics or income, maybe accounts and balances. And ideally, to improve that relationship, you really want to provide insight into those customers based on what their behavior is, which is where we're all moving to. What is their behavior? How do you know what their behavior is? And could you actually have the segmentation be determined by the data itself? Not necessarily the segmentation you want to put on your customers, but actually what the data tells you the segmentation should be. And we'll talk quite a bit more about that. Right now, I get offers, I can see that it's a mass offer. It's got limited value to me. Wouldn't it be great and ideal to create target offers based on what a financial event might be for your customer, what a predicted event might be from a spending activity base? Are they all of a sudden going to Target all the time and they're buying, diapers? So obviously they've got no children. I mean, that kind of targeted offer can be incredibly powerful. Acting on individual events, so acting on the customer's propensities based on their spending behavior and changes in their life, and then responding to the inbound requests that you get from customers. Right now, you respond based on those. Wouldn't it be great if you could proactively do it? Could you anticipate their spending? Could you predict the spending they might do and what the financial impact would be? There is an opportunity right now for banks to transform how they interact with their customers. And so what I'm showing you right now, and I think this helps clarify, what I'm talking about here as far as a solution is concerned. What you're seeing is a graphic that kind of describes what this solution can do. How it can use, so if you look at the middle and you look at the data at the bottom there where you have the customer data, the payment data, the transaction data, et cetera, all that is included in this kind of solution, because all that data together helps you segment your customer, and it helps generate segments based on their behavior, which is kind of the upper left that you see there. And based on those segments and based on understanding that behavior, you can start to predict future life and financial events, as you see in the upper right there. And predicting is really gives you an advantage with your customers because now you can target them individually, not en masse. Predicting the likelihood of financial activities and churn based, as you see in the lower left, is also another aspect of this kind of solution because you understand more about your customer. And so what you're really doing is you're using these insights to drive what you present to them, individually present to them. So you can improve cross-sell, you can reduce attrition, which you see the benefits at the bottom, and you can generate new revenue streams, which is really what banks are trying to do. They're trying to generate new revenue streams and increase profitability. So what I want to do now is kind of give you an idea of what it looks like as you as a customer sitting in front of your computer or you're using your solution. What would it look like to you? So what you're seeing is an example. Actually comes from a live demonstration. It's a screenshot. It's not the live demo. We didn't really have an ability to do that here. We didn't have the time. But what you're seeing is a screenshot of a live demo that we're doing right now with certain customers, with actually quite a few customers, small and large banks, where you see what as you see at the top in the black there, Christine Draw on the right-hand side. That's the user. It could be the relationship manager, it could be an executive in a bank. And you see an executive dashboard where there's this information about this customer, Michael Veronin. What his projected overdraft details might be, what his income is, the assets that they have, the last exchange, his address, what social interaction does he? You can see in the middle of the screen, and he uses Twitter, he's on LinkedIn, he's on Facebook, he does email, he's chatted with us, what channels does he use, the likelihood of his overdraft based on his behavior. A lot of information, obviously customizable for every bank, but a lot of information about that particular customer. You can see here where Christine can also look at the segments that have been identified based on behavior and likely events. So it's not the normal segments that you might see. It's a segment based on a home body, golden years, startup dreamers, high flyers. These were all segments that this organization wanted based on behavior. The behavior told them that these were the segments that they should look at. It's not all the segments they would look at, but here's a list of segments that they could look at. The likelihood of, what you see in the lower left, of key activities for a home body segment, both from credit request to investment contacts. These are all predictions based on that behavior. The top segments with overdraft propensity, and based on this information, you can start to take action with those customers that fall into these particular segments, all based on the data that was, the behavior that was seen in the data that was generated or that was put into the system. Another example, drilling down to identify groups with similar behavior patterns. Again, here Michael Baronin shows up, all the other customers in that segment show up. Where they spend their money, how they spend it. You can see it's a very powerful way to understand better your customers so that you can improve the relationship, create insight about the individual customers, and target them for cross-sell, for communication, to get in front of them ahead of a potential for overdraft. All of that can be done with this kind of solution, and it's available now. It's being used by banks right now, and it is incredibly powerful in creating your relationships. So that's what I wanted to really cover there, and I'm gonna switch over now to profitability analytics. And I know that the transition here, sometimes there's a lot of questions at the end of some of these sessions. Please put them in the chat. We'll get to them. But we've got quite a bit of topics to go through. I want to make sure we keep on track. And I want to switch over to profitability analytics right now, but it's important to know that this is all tied together. It's all tied to the customer. And in our experience, both ECAP and IBM, we realize that many banks, small and large, have a limited view of their profitability. It's usually calculated at a bank level, not necessarily an account or customer level. It's sometimes limited in what you're really calculating from a profitability perspective. Sometimes it includes transfer pricing, sometimes it doesn't. Cost allocation, it's all obviously data dependent and can be difficult to do. But in the end, if you can't measure it, you can't effectively manage it. And that's really what solutions around the customer is all about. Because to be customer centric, you need to understand profitability at a multi-dimensional level. You need to know the why behind profitability. Which business units are profitable? Which channel is most profitable? Which products are most profitable? What relationship managers are contributing the most to profitabilities? What branches are most profitable? All of this is tied together. It all impacts your customer-centric relationships, and understanding profitability in a multidimensional way is really what's needed to do this. And it's important to know that and we'll get to this in the end, when the data is available and it's reliable, this is not that difficult to do. It is data dependent, and we'll talk about how to make that happen, because everything we talk about today depends on reliable data. And I want to paint a bit of a scenario around this, just to give you a clear picture of how we view the profitability scenario. And if you go right to the bottom of the slide here and look at that little graphic, capturing your customers' attitudes and opinions, gathering that together, gathering their behavior, understanding how they interact with you, what their spending behavior is, where they are in their life journey, is important to being able to predict their behaviors. And once you predict their behaviors, it is, you can actually act on them. That's once you have to know the best channels to market, once you know what their lifetime value is, the ability to act on that is what's important, because just understanding it gets you only so far. If you can't act on it, then then you're really, it's not going to improve your profitability. So using analytics to identify and profile attributes, which we talked about just in the previous discussion, is really helps you understand who your most profitable customers are. And creating the ideal customer based on that behavior is important, because then you can understand what products and services not only do they use, but what they could use. You're predicting what they will use in the future. And you're using analytics and decision optimization to pinpoint the best offers, because you want to pinpoint, you want to focus on your ideal customers because you want to make them more profitable. It is less cost for you to make them more profitable. And using predictive analytics allows you to predict the channels these customers will most likely respond to. So all of this is tied together around the customer. And in summary, what you're creating, this unique view of your customers, helps you separate yourself from your competitors, because it's hard for organizations to do this. And once you can get there, you've really separated yourself. When you understand who they are, who your most valuable customers are, you're going to, and what they want and how they would behave in the future, then you can predict, and then you have the ability to act. So you can act on those unique insights. And really, if you want to introduce a new product or a new service, once you understand your customer better, it's just much less cost and much quicker to make those products and that new service profitable. And what I want to do here again is give you some examples of real life solutions that are in the market right now around profitability and tying those to the customer. Here you see an example of a retail banking executive dashboard, and I'll show you one on commercial as well. But you can see that with the right data and the right information, you can see, and it's a little fuzzy, I apologize for that, the screenshot didn't come through perfectly on this one, but you can see the retail bank profitability that you have on the left, the credit product profitability. You have a retail snapshot on the bottom. You see your charge-offs and write-offs. If you have key performance indicators, you can do that by not just region, but by branch. You've got your consumer deposit portfolio by branches, and these are all customizable dashboards, of course. But whatever's most important around customer profitability can show up in these dashboards and in the solutions that are available today. Again, from a retail bank perspective, predicting net income after taxes is an analysis that is often done and important. You can see the actual versus predictive, because once you have the right information, you can start to predict your net income after tax. Here it's done by profit center with households and customer IDs. FICO scores, so you can break it up by FICO scores based, what you can segment by FICO scores. You can start to break it up by that. You can also see the FICO score by your individual customer ID. It's a real powerful way to look at predicted profitability for certain branches and regions. And again, moving to a commercial banking perspective, looking at leading concentration by industry, which you see in the lower left there. A commercial snapshot, which you see in the bottom middle, looking at net income after taxes all the way through total revenue. Your top 5 resource manager or relationship managers, corporate bankers in the upper right. Again, KPIs. Just a lot of critical information around the commercial banking part of your organization. Looking at product profitability. For commercial banking, sorting that any way you'd like, having the ability to navigate through product profitability. Again, totally customizable, but very powerful information that that really focuses on the different dimensionality of your profitability. So I think that what you'll see here is going to generate, if it doesn't generate interest for you, what we want to do is be able to obviously drill down into more detail with you and be able to do that in future sessions. So with that, and again, I'm going to switch to regulatory compliance analytics, and I do this saying that again, this is all tied together, because regulatory compliance is really about how you interact with your customers, as well as you know, everything you have to do for something like Dodd-Frank or something like SOX, but it's all again tied together. And here's where data becomes even as critical as the customer data, but data is absolutely, and the reliance on that data is absolutely critical to your ability to do this. So jumping into this, I don't think I need to harp on this, or we should really spend a lot of time here. You know it, everybody knows it. It's increasing at an alarming rate, and it doesn't look like it's going away. And no matter who gets elected, I don't think it's going to change. We all know that it's critical to what financial institutions have to do. And really what we believe and what we've seen is that without sustainable compliance, it's very difficult to manage your regulatory environment. And it puts you at risk. It puts you at risk for your ability to grow. It puts you at risk with regulators. It puts you at risk with your customers. We know that sustainable compliance is absolutely what's going to drive more efficiency into managing compliance. And we believe there are 4 areas that are critical here. I'm going to talk about this in a bit more, and I'm bringing up the word cognitive, but leveraging a cognitive-based solution we feel is important, and I'll explain what that means because there's a lot of definitions around what cognitive is. But it's really about automating your ability to understand what your obligations are and what your requirements are for the regulations that are affecting you, and helping to understand the impact that it has on your business. A regulatory repository that links what the obligations are, what your requirements are, to the controls that you have in place and the policies you have in place. Having that repository and having that one version of the regulatory truth is critical. And being able to compare it to industry standards and what good practices are is also a key to the sustainable compliance environment. And since these regulations are changing constantly, there's opinions coming out on the regulations, there's changes to the regulations. I can't remember the number of Dodd-Frank changes that have happened so far, but it's staggering. But creating a platform that supports ongoing maintenance and the remediation of controls is also a big part of sustainable compliance. And in the end, you have to respond to the regulators. You have to prove that you have the right controls and the right policies in place to meet the obligations and requirements of those regulations. So advanced reporting and analytics that you can quickly get to, that are there for you at your fingertips, let you respond quickly, reduces your cost, and let you move on to what you really want to do, and that's generate more business and more profitability. All 4 of those are critical to sustainable compliance. So I'm using this slide now to really introduce the whole idea of a cognitive-based solution and the automation of regulatory assessment. So there are solutions in the marketplace right now. We have a solution in the marketplace that actually will read a regulation document. It will take the document itself and read it. I use natural language processing to read it and understand what each sentence means through a series of linguistic understandings, through learning, through algorithms, but it identifies from that document what your potential requirements or obligations are. So using this solution, a compliance analyst in your organization, someone that's responsible for understanding what the obligation or what the regulation is and what the obligations are, can use this solution, this tool, to improve their ability and decrease the amount of time it takes to know what those obligations are. So what the solution does is it says, you know what, this particular paragraph and this obligation has a 75% chance of being an obligation for you based on how it fits into your bank, what part of the bank it fits into, what its dimensionality is, in other words, what jurisdiction it is, what type of regulation it is it commercial bank related, is it retail bank related, all of that is part of the solution. And then it can map that obligation once you identify it and say, yes, that truly is an obligation for us, and it lets you do all kinds of things with it, add comments, keeps a full history, but it can map that obligation to the controls and policies you have in your organization that would satisfy that particular obligation, and then move right into analyzing reporting. So it's a end-to-end solution for managing your regulatory compliance. And this is a very high-level view. We have great demonstrations around this. Would be happy to, dive deeper at some point in time in the future. But it's a full end-to-end solution based on a cognitive capability. And just to give you kind of a vision and roadmap of what this means, and it doesn't, you don't have to do this one regulation at a time. You can do multiple regulations at the same time. But it's understanding the requirements and then addressing those requirements based on your controls and processes needed to deliver evidence to the regulators. And you do it with truly mapping and understanding what controls map to what obligations, because most organizations are wasting resources and have controls, too many controls for the regulations that they have to have requirements for. So they may have 5 controls that map to 5 different regulations when one of those controls could satisfy the requirements of all 5 regulations. So it really can reduce your cost and make your whole process much simpler. And so you can see here the obvious benefits: reducing time and costs, to understand what the regulatory requirements and obligations are. As I just described, eliminating the duplicate and overlapping controls, and improving your understanding, which is really what has to be done. I mean, in the end, regulations are all about delivering evidence to the regulators. You don't want to get dinged for regulation, not meeting a regulation. It costs money. It costs to your reputation. The better you can manage your whole regulatory environment, the better you will do in your growth and your ability to improve revenue and reduce cost. And again, some screenshots that describe or that show this kind of solution. Here is a series of regulatory documents that have been input into the system. It kind of gives a little bit of a description of the regulatory document that you click on. Here is a screenshot of when it has read the document into the solution, where it's determining, as you see on the right-hand side, that there's an 80% chance that this particular paragraph is a obligation or a requirement for you to meet this regulation. You can accept it, you can reject it, you can add comments. So this is just another example. Here's an example of a report that's comparing 2 different regulations together and the controls that you have in place for those regulations, and determining which controls are in place that apply to both regulations. And you can do this for obviously multiple ones, but just another example of what this kind of solution can do in helping you manage your regulatory environment. So in keeping with the time here, I want to make sure I left some time to really talk about not only risk and data aggregation in the bank, but the whole idea of reliable data that lets you do all the things we've been talking about. And so with that, I'm going to turn it over to Mike.
Thanks, Chuck. Mike Twaddle. I'm an analytics client architect, financial services sector in IBM. I have 28 years of banking experience and extensive experience around risk and finance and back office systems within banking, working for a large global bank. Since joining IBM, I've been working with mid-tier and large banks on their risk problems, and more particularly around risk data aggregation and how they put all that together. A little bit of background on all of this. And so Chuck talked first about knowing the customer, how we would drive sales to customers and do some things around predictive selling. We got into financial performance and then into some of the regulatory things with compliance. This all ties together here in that to have any of those things happen well within a bank, it all requires data. And banks, more so than most organizations, are very data-centric. Everything spins on the data. And clearly, with what I'm going to talk about today, the back office functions of financial risk and risk data aggregation and how that can actually be fuel for growth for a bank, absolutely very much data-centric. And the bulk of the problems within banks and able to do risk analytics and help drive profitability, help drive appropriate risk pricing of products is all data-centric. So a little bit of background around risk data aggregation and regulatory compliance, what banks are facing right now. With the last economic downturn, all kinds of new regulation came into place, affecting small to mid-sized and large global banks. Among those are DFAST, Dodd-Frank Act, CCAR for the larger banks in the U.S., and BCBS 239 globally, and even holding companies for large global banks that operate within the United States. Very, very expensive to get all these things right. Typically was underinvested in banks around having the architecture on the back end for risk. But clearly they're investing right now, a lot of with manual efforts. But we're looking at what some of the value is around getting all the data right so you can get all of your analytics correct to help drive the bank. So with all the complexity surrounding risk and risk data aggregation, it's still fundamentally a data problem within a bank. And so being able to sort out those particular disciplines around risk, to be able to get faster analytics around risk, take risk from a back office function that's a look in the rearview mirror of what happened a week ago or even a month ago, and be able to get analytics and insights into risk data that can be moved to the front office to go drive business decisions is where banks want to be. Chuck, the next slide, please. Great. And so all banks right now are taking a look at how they have all the risk controls in place, how they talk to regulators about them, how they evidence to regulators that they have appropriate controls and that they have a control around all the data and all the disciplines around data that goes into the analytics for both the reporting for risk to regulators, but more importantly, what is used to drive decisions within the bank. And regulators are asking more detailed questions about this. In the past, it was okay to just put together your reports, send them off to the Fed, have them reviewed with regulators, have conversations about them. But now they're starting to ask questions about where did all the data come from? Can you show me the provenance of the data? Can you talk about the disciplines that are in place and all the policies around stewardship and governance of that data? How is it shared, used, and provisioned across other functions within the bank? In other words, the larger ecosystem of risk. How does it relate to finance? How does it relate to treasury? How do you share data? How do you make sure data is consistent between those functions of the bank? And trying to understand things like lineage. You know, where did all the data come from? Can I show where that came from? Not only to the regulators, but that's really integral to being able to go manage all that data and drive cost out of the risk function within a bank. And lastly, things around data quality. Do we understand that the data is granular enough? Is it all the quality measured and managed across the entire chain of data provisioning that's used for risk and extends again into finance and into treasury? The point I want to make is, as I'm going through all this, while I'm talking about a back office function of risk for a bank and financial risk is really the other side of the coin of profitability. And while it's more sexy to talk about the front-end customer-facing systems and about how you drive revenues, the fact is that you can't significantly drive revenues in a bank without getting commensurate increase in your risk as well. Just the way banking is. The other side of the coin of profitability and driving revenues is managing risk. And as we saw with the financial downturn and the subsequent consolidation of banks, banks that do a very good job of either maintaining all the controls around risk and visibility around risk tend to survive downturns better and are in a position to go swallow up banks that do not do this well. And so we're seeing all this regulation and the cost of the regulation driving consolidation in the banking industry and certainly affecting profitability for banks. So a common theme across all this regulation that's out there, and part of the message that we give banks here is if you have controls around your risk data aggregation, whether we're talking about CCAR, we're talking about DFAST, BCBS 239, you're much better positioned to be able to go respond to this regulatory change, and it is always changing, not only do it quicker, more accurately, and with a better cost profile than the competitors. Regulators asking questions from a data perspective, asking about completeness of data, how it gets aggregated across systems, understanding where you have operational risk, where there's either manual accumulation or aggregation of data for risk processing, the timeliness of it, of how it gets put through in order to make business decisions, accuracy of the data, adaptability of your whole infrastructure and architecture about ad hoc reporting. Not only internally is that a benefit to a bank, but oftentimes regulators will ask questions that might be outside the norm of regular reporting. And reporting around risk within banks tends to be fairly rigid. And anything that's asked for that's out of the norm is usually a handcrafted, unique effort based on a particular response. And the question always becomes, if you are to ask that same question again, would I get the same answer? Giving it to humans to go try to go put all this data together. Next slide. Great. So risk data aggregation. Really, this is a transformational program for banks about how they go about this. And there's two main points I really want to give out of this slide here. And one is banks that we see doing this at pace and driving business value and monetizing the investment in what they're doing around compliance or financial risk, focus on the business outcomes internally. And there are methods and ways and approaches to financial risk and risk data aggregation that drives internal benefits to the bank as well as tick the boxes with the regulators. And so rather than being just in regulator jail and responding to regulator requests, you can get both things done, drive profitability and help grow the bank and drive competitive advantage as well as tick the boxes with the regulators. And you can think of these three boxes here on the slide as being the what in the upper left-hand corner, the how in the middle, and in the lower right-hand corner, the why. And banks, again, that focus and actually get results focus on the why and the real business outcomes they want to get. So banks might have, issues around opaqueness in either the processes or data around particular asset classes. Being able to focus on those to help drive clarity within the bank and being able to tick the boxes with the regulators at the same time is a huge benefit. And really, if you took a look at all the regulation that's out there right now, and you were to abstract it out to what regulators are really asking banks to do, through all the detail that's out there, it's the 3 points that are in that blue box there around risk analytics. They're asking banks to have accelerated, more sophisticated analytics and more granular across all their different risk functions and be able to tie that in with their finance and treasury systems. They're asking that those risk analytics, again, I was talking about it being a look in the rearview mirror, be able to accelerate all those things, take it from a back office operation, and be able to move those analytics more towards the front office so they can be used to drive business decisions. And lastly, the whole predictive and cognitive piece around risk analytics. If I'm able to get all my data right, I'm be able to increase the velocity of quality, granular data through my system, I'm able to do things that I wasn't able to do before. And a good example of this is, in terms of assuming risk within a bank, if you wanted to increase a risk appetite around a particular asset class, do you have all the data available to be able to do the analysis around what would that mean to your P&L? What would that mean to your profitability of the bank as a whole? And what would I do to mitigate any additional risk that I could go take on? And so these are all the things that regulators are really asking banks to do. If you had to go boil down all the regulation, is to get to those 3 bullet points that are there in the blue box in the lower right-hand corner. Next slide, please. So this slide here shows a reference architecture around financial risk. It includes some elements there around operational risk as well. And you show this to any financial institution and they will understand this. And this talks a little bit about all the data sources there, how you would go do the aggregation around data, how you could do it in a more cost-effective and simplified way, run all the granular data, be able to source it through multiple functions within risk and finance perhaps, be able to return all your results set somewhere, like data reservoir, and be able to do analysis across different silos of risk within a bank. This is huge because there's often difficulties within a bank right now is to be able to look across those different silos, to be able to share data, to be able to get the economies of scale and the disciplines around data provisioning to drive cost out of this whole ecosystem around risk as well. Other main point in this slide is around the capabilities here, that banks have to be able to improve to be able to respond to the regulatory requests. And part of the hypothesis here when we talk to bank customers in general is while regulation is something we live with, and we've seen all the Basel things come through, we've seen DFAST, CCAR, and we know that the next economic downturn, there's going to be more regulation. The way that banks insulate themselves from regulatory challenges are developing those core capabilities to allow them to respond, again, faster and more accurately and with a better cost profile than what they did in the past. And the capabilities listed here, and we'll see some common themes again to what Chuck was talking about, MDM and RDM. If I don't understand my customers on the front end, it's unlikely I understand all the pooling of counterparty risks on the back end. And by that I mean I might have relationships between a holding company and their suppliers, manufacturing companies. To be able to pool all those things together and understand aggregated risk around those is very useful. Reference data management within the bank, how do I manage my reference data and do I do it consistently and consume it consistently and at the same point in time for different functions within the bank? Very much depends on what the numbers look like on the back end. Getting all your data integration and enrichment right to be able to put all those things together, be able to flatten out those architectures, data quality and profiling. Very important around information governance. Regulators always ask about that. What are your disciplines there? And metadata management as well. And metadata management is a foundational piece to allow the function of information governance to actually happen. To have that, the levels of visibility around not only the movement of data across systems, but mixing that in from the conceptual side on the business around definitions of all the data, the taxonomy of all those definitions that really represent the intellectual capital of how the work and data gets used within the bank, through all the logical view of data and the models, all the way through to the physical side. Where does data reside in physical databases, columns, tables? Where does it get referenced within reports? All of those things, be able to pull all those together now allows a bank to, and bank workers, knowledge workers around data, to enter and look at metadata related to their own function and also draw into other contexts, whether it be from the business or from the physical side in IT, and be able to pull all those together to help go solve those problems and get that visibility to simplify those architectures to drive out cost and accelerate that throughput of information. Chuck, next slide. Chuck, I think we are at the summary here. I'll let you wrap that up.
You bet. Thanks, Mike. Just in summary, before we get to any questions here in review, you know, the whole customer insight side of this is all about your relationships with your customers, and you want to use that to improve profit and revenue. You want to increase revenue and profit, and that's something that every bank is facing, small, medium, or large. Understanding all the different dimensions of the bank's profitability can really improve your cross-sell and help drive more customer and product profitability. I think we definitely talked about that. It's very costly to comply with all the different regulations, but using some of the new cognitive analytic capabilities, having the technical solution help you and assist you will definitely reduce your costs. And of course, being able to predict can can help you target customers with new products, new services, and help fuel revenue growth. And in the end, as Mike just talked about and covered, without the reliable, trusted data, it's impossible to do any of those, and it's required for all of the above. And we don't mean to make that sound daunting either, because we've had a lot of experience around making that happen and making it happen in a way that is consumable by community banks, that is, from a cost perspective, reasonable for community banks. We've got some great tools and solutions, both ECAP and IBM together to make that happen, to make all of this happen. So with that, we want to turn it over to Q&A. And Austin, I'm sure if there are any in the chat that we need to respond to that you might have.
There is one question that just came in. What are some of the architecture challenges to simplifying the risk data aggregation? And so as you're thinking of the answer on that, I'm going to go ahead and start to unmute the lines. The other attendees are welcome to place their questions in the chat window, but we'll also be opening up the lines here in a few moments if you have any live questions. So to repeat it again, what are some of the architectural challenges to simplifying risk data aggregation?
Chuck, I'll go ahead and take that if that's okay with you.
You bet. You bet.
All right, so a lot of architecture challenges. First off is being able to understand where your current state is around how you do your data provisioning for risk. And really, as I work with bank customers, and it's borne out by my own experience, 80% of the cost, risk, and time around preparing regulatory reporting and doing risk analytics within a bank is all on the data side. It's about how we do integration, how we put all those things together. So therefore, the emphasis on risk data aggregation, simplifying those architectures to take out some of those pieces that are over there. And so establishing what a current state is, being able to establish what a future state is, kind of what I showed in the reference architecture around risk data aggregation, and then putting together real sensible plans on how you get there from here is some of the challenges. The other one on the business side is actually twofold. One is around taking a look at the disparate functions in the bank, like finance, treasury, and risk, getting them to come together and understanding all the interconnections between them and getting them to work together to how they could do common data provisioning and do data provisioning that makes sense, that drives that cost, and again, accelerates all the quality data for doing analytics. The last part of it on the business side is most of the issues around risk data and back office functions within a bank in general happen in account opening and account maintenance, and where they either have incomplete or missing data around customers that are maybe not required in the front-end systems, but are absolutely required to be able to classify assets and counterparties on the back end. And so a huge challenge within banks is, while risk or finance or treasury might be a back office function, how do they influence the front office systems and lines of business to make changes not only to their business processes, but to their systems and budget for those to help correct some of those data errors that have to be addressed in the back end. And so organizationally, having people who are responsible, who have remit and budget to go fix those problems and the appropriate gravitas, that's a huge impediment to being able to make progress in this area. I don't know who asked that question, but hopefully I answered it correctly.
Yes, thank you, Mike. We do have a couple of questions that have queued up, but I'm going to go quickly to the phones. I've unmuted the lines to see if we have any live questions that the participants would like to ask. Any questions from the group? All right, so we'll come back to you in a moment, those on the phones. But the next question up we have from the chat window, this has to do with kind of getting started. What data elements are banks using to help drive customer insight?
Yeah, I can take that, Austin. Right now, just to kind of give you a laundry list of the type of data that's being used for the customer insight example I showed you. Obviously, there's, the customer database, the customer information, what transactions are being produced by those customers, the loan information, payment information, emails that they use, that they interact with the bank on. So any kind of interaction with the bank. There's external data that's used. Actually, U.S. Census data is used for some of the information, helping with being able to segment customers, and social media, being able to understand from a social media perspective what your customers are saying about their interaction with the bank and their just overall lifetime behavior, what they're doing. That information is being used in that type of solution as well. All of it together helping provide the customer behavior analysis you need to do to really understand, the insight, give you the insight for your customer.
Great, thank you. Thank you. I'll go ahead and unmute the lines here one more time to see if there's any questions, and then we're also approaching the top of the hour. Do you have any questions from the folks on the phone?
It's a process at the beginning that lets you focus in on what you want to get from social media. Hopefully that helps.
Great, thanks. Well, we approached the top of the hour, and I want to thank everyone for their time and respect their time. We'll be reaching out to you via email. Would love to get your feedback to understand if this session was helpful, how we can improve others in the future. And we'll also include our contact information. So if there's any questions you might have, we're more than happy to help drill down on each one of these areas. We covered a lot of information today, and it's very passionate to each and every one of us between eCapital and IBM, and we look forward to helping solve some financial services challenges with you in the future. With that in mind, thanks, and have a great week.
Thanks, everybody.
Thank you.